I was losing, and I refused to let go. It's one of the most common and costly investor confessions. The position was down. The thesis was weakening. The evidence was changing. But instead of cutting the loss, you doubled down. You waited. You insisted. Why? 1. Loss aversion, the pain of admitting defeat. Research by Daniel Kahneman and Amos Tversky shows that losses hurt about twice as much as equivalent gains feel good. Selling at a loss doesn't just reduce capital. It creates psychological pain. I was wrong. I misjudged. I failed. So instead of accepting the loss, investors hold on. Not to recover money, but to avoid emotional discomfort. 2. The sunk cost fallacy. Once time, money, and identity are invested, walking away feels wasteful. I've already put so much into this. But markets don't reward commitment. They reward correct allocation. Money already lost is gone, whether you sell or not. Refusing to sell often becomes an attempt to justify past decisions rather than optimize future outcomes. 3. Risk-seeking and losses. Prospect theory reveals something counterintuitive. In gains, people become risk-averse. In losses, people become risk-seeking. When a position drops, many investors increase risk to get back to even. This explains averaging down without a revised thesis, refusing stop-loss rules, ignoring new negative information. It feels like courage. Often, it's denial. 4. Ego protection. Losses threaten identity. If you see yourself as analytical, rational, skilled, then admitting a mistake challenges that self-image. Holding becomes a defense mechanism. The position transforms from an investment into a personal statement. Now you're not fighting the market. You're fighting embarrassment. 5. Hope versus strategy. Hope is powerful. Investors say, it will come back. It's just temporary. The market is wrong. Sometimes recoveries happen. But stubbornness without updated analysis isn't strategy. It's emotional attachment disguised as conviction. 6. Why this is so dangerous. The real cost of stubbornness isn't just the loss. It's capital trapped in weak positions, opportunity cost, emotional energy consumed, compounding delayed. Markets, like the S&P 500, historically recover over time, but individual stocks often do not. Confusing the two can be expensive. 7. The hardest skill in investing. Buying requires optimism. Holding requires patience. Selling at a loss requires humility. And humility is psychologically expensive. The deeper insight. When you say, I was losing, and I refused to let go, you might actually mean, I couldn't accept being wrong. I didn't want the loss to become real. I believed persistence would protect my ego. But markets don't negotiate with ego. Final thought. Discipline is not about never being wrong. It's about correcting mistakes quickly. Stubbornness feels strong in the moment. Flexibility builds wealth in the long run. Sometimes, the most profitable decision is the one that hurts your pride the most.